Good morning. Thank you for joining us today for our Farm Foundation Forum, Keeping the Farm Together, Impacts and Issues of Current Tax Proposals. We're glad to have you with us today for our discussion. My name is Sherer Rogie-Fiddler, and I'm the President and CEO of Farm Foundation, located just outside of Chicago, Illinois. I'm also a fifth-generation farm owner-operator from Nebraska. Today's topic is near and dear to me as my own family works through questions of succession planning and financial management across our multi-family member and multi-generational operation. That's just one of the reasons I'm looking forward to today's discussion, as I know there are many challenges, opportunities, and even uncertainties still ahead with tax and estate issues for farm families. We have lined up an excellent panel to dig into those topics today. Before we get into today's program, I'd like to take just a few moments to share a bit more about Farm Foundation. We are a 501c3 nonprofit working at the intersection of agriculture and society to address challenges that affect the entire food and ag value chain. Specifically, we are an accelerator of practical solutions for agriculture, accelerating people and ideas into action. The three levers we use to accomplish this are policy, innovation, and education. Forums such as today's are just one part of our extensive program of work, which is guided by our mission to build trust and understanding at the intersection of agriculture and society, and our vision to build a future for farmers, our communities, and our world. We rely on partnerships to fund our work and increase our impact. So if you're interested in learning more about funding or partnering with us, I invite you to reach out to explore collaboration. One easy way to support our mission is to become a friend of Farm Foundation. Any individual can become a friend of Farm Foundation's and will receive exclusive benefits such as first access to our issue reports, curated content, and more. We will provide a link for this in the chat function today at the beginning and end of our forum, and thank you in advance for your support. I also encourage you to learn more about Farm Foundation and our work by visiting our website at farmfoundation.org or connecting with us on our social media platforms. If you are posting on social media about this morning's session, we ask that you please use #FarmFoundationForum. As we get underway with today's forum, I'd like to quickly go over a few housekeeping notes. We invite you to submit questions by clicking on the Q&A button at the bottom of your screen. Please do not use the chat to submit your questions. When submitting questions, please include your name and organization. And due to time limits, we may not be able to ask all questions submitted, but we'll certainly do our best. This forum is being recorded and will be posted on our website at farmfoundation.org, and we'll send out that link following today's program. And finally, when the forum concludes, you will receive a link to a short survey. Farm Foundation appreciates your feedback and your time in completing the survey. Now let's turn to today's forum topic. We have an outstanding panel of experts who will discuss possible tax and policy changes and how those might affect farmers' estate and succession planning, transfer tax, income tax, and more. I'd now like to introduce our moderator and discussion leader, Paul Neiffer, principal of the Agribusiness Group at CliftonLarsonAllen. Paul is an agribusiness certified public accountant and business advisor specializing in income taxation, accounting services, and FSA planning related to farmers and processors. Paul authors a monthly column for Top Producer magazine called The Farm CPA, and he has written several articles for various farm magazines and media outlets, and instructs many CPAs and CPA firms across the US. Paul is the primary author of the blog farmcpatoday.com, which reports several times a week on items specific to the ag industry. Paul, I'll let you fill in any gaps and I'll hand the baton over to you now. Thanks, Paul.
Thank you, Sherry. Let's go ahead and get started here. I think I would say probably 2 weeks ago, I felt more comfortable that I knew some answers, but after the last week or so, dealing with the proposed tax law changes coming out of Congress right now, I'm not sure if I'm quite as confident as I was maybe a couple weeks ago. We know that it's in an extreme state of flux right now. We have President Biden getting ready to head overseas to go to Scotland to discuss or present his ideas or America's ideas on climate change. And part of that is President Biden was hopeful that the Build Back Better, and I can't say that fast 3 times, Build Back Better Act would be either passed by then or would be in the process of knowing what the rules and how the taxes are going to be raised. As we all know, the deadlines in Congress, originally there was a September 30th deadline, and then there was a October 31st deadline. They're not going to meet either one. Realistically, we always know any major tax law that's going to be passed is likely going to be passed right around Christmas time. As advisors, I'm a CPA, we have attorneys, et cetera. It's just the reality is typically they're going to be passed in December. So since that's still 2 months to go, likely what we know now will not be the final result. But let's go ahead and let's go to our next slide. So I just want to give everybody sort of a quick overview. And actually these slides were probably written fairly recently, but they probably already changed a little bit. Rates are headed up. Now, if we go by what Senator Sinema has said and indicated in the press and so on, and she doesn't talk to the press, but we know what she says, the actual income tax rates, both on corporations and on individuals, may not go up, but there will be certain things that will go up, such as net investment income tax now likely will be applied to all business income. Currently, it's only on investment income. That's an extra 3.8% tax. They already released yesterday a proposal to have Social Security taxes, the 12.4% tax applied on all earned income over 400,000. That's not part of the new 2 trillion, whatever it might be, bill, but it has to be a separate bill because it can't be part of reconciliation. Now, will it get through? No, it'll die in the Senate, but that's where they're headed. Capital gains, we thought we would have higher rates, but the reality is Senator Wyden, who is the chairperson of the Senate Finance Committee, finally came out with his slender proposal on mark to market. It's only 107 pages long, the actual bill, but that's supposedly for billionaires. Now, several of you probably listened or watched Ag Day yesterday. I think I was on there, and essentially I said that if this does go through, it's a Trojan horse, and likely that means within 10 years, probably half of the farmers may or may not be subject to mark. They'll start with billionaires, and then to raise money, because it's a great way of raising money, it's very easy to just keep dropping the dollar amounts, and eventually, like I say, a lot of our farmers, what I traditionally would view as farmers or other people on this call, on this webinar, would be subject to it. Corporate taxes, personally, for a lot of my clients, I was sort of hoping the proposal would go through because they're going to drop the rate down to 18% on the first 400. A trust, I think Senator Sinema and Manchin don't seem to have any issues with the changes to the trust. That would affect a lot of our whether they're farmers or business owners or people with moderate amount of wealth. We're not talking large amount of wealth, we're just talking moderate amount of wealth. Grantor trusts likely are on the chopping block. We'll probably discuss that a little bit later on. Let's go to the next slide. Estate taxes, the House proposal had some discussion about dropping the exemption down to the old exemption that was in effect as of 2017. They would drop that next year instead of in 2026. However, they did discuss for our farmers out there that 2032 Cap A would be increased. It would basically go up by a factor of 10. But the bottom line, rates, are they going to stay the same? Step up in bases, the transfer tax is likely dead, but I think step up in bases may or may not occur. I don't think right now, as far as I can tell, Senator Sinema and Manchin may say, hey, in return for not increasing rates, we'll eliminate step up in bases. I believe that's still on the table. So those are sort of the items that give you a nice overview of where we're at right now. And again, I just want to reinforce when we have the Q&A, a lot of our answers likely are going to be either we really don't know or it depends. and it's always going to be in a state of flux, but at least we can give you an educated, we don't know. So with that, I think we go to the next slide. So that's my brief overview. Again, I will be the moderator. I am now going to hand it over to Eric Gullicksrud to continue the conversation. Eric is a vice president of tax and accounting at Compeer Financial. Eric did grow up on a dairy farm in Strum, Wisconsin, and worked as a loan officer with Production Credit Association. Many of you remember PCA, you know, that's been a few years back. He was there with PCA for 11 years before moving into the tax department since 2010. Eric is also a part owner in his family's 2,500 head cow dairy. So Eric, I'll turn it over to you.
Well, thank you, Paul. I kind of wanted to start out here, giving a little bit of a background of what the step-up basis is. You know, and some of you on the call probably understand this, but a lot of times when I'm dealing with the clients, farmers, and they start talking about basis, I get this deer in the headlights look, like, what are you talking about? And it isn't a very important concept, especially when it comes to estate planning and that type of thing. So just to give, I want to start with that, the basics here of basis. And, you know, it's your original basis in property is adjusted, increased or decreased by certain events. Then, for example, if you add some improvements to that, add up, you know, some other items, your basis can go up. Likewise, if you take depreciation, have a casualty loss or some credits, you can actually reduce your basis. So the basis is a very important concept in tax for sure. And so what I have here is an example of a basis. So I purchased a tractor in 2018, $100,000. I bought it straight out, and you take off the depreciation. So today, my remaining basis in this tractor is $64,286. So just wanted to give you a basic example of what basis is. So when we move into inherited or stepped up basis, what we're talking about is basically it's inherited will have a basis equal to its fair market value at the date of the decedent's death. And that's what we call the stepped up basis. Now that is going to depend on which state you're in. Community property state like Wisconsin I'm in, we can get a full step up basis. So mom or dad pass away, we get a full step up basis. Everything's appraised and determined what that new basis is. So again, it depends on what state you're in. The surviving spouse, you know, will either get a whole or half up there. And appraisals are highly recommended and really almost should, I tell my clients, required. So we have something to hang our hat on. Where did we come up with these values? So the basis step up basically includes pretty much everything that the owner owns. So we've got real estate, the buildings and improvements, machinery and grain and livestock, and growing crops and inputs. And that's an interesting one for the growing crops. For example, if the farmer, you know, deducted all this seed and fertilizer in December and passes away in February, or even after that, all those expenses or costs, it's an inventory item, could all be taken as a step up and re-expensed. So any assets of any value should be considered supplies, whatever it is that the farmer owns. One of the other differences here is corporations. It is not quite as lucrative because of the assets inside the corporation do not get the step up, but they are all valued, and then that increases your basis in that corporation. So the person inheriting those shares will not see really the value of that step up until the day that they sell the corporation. So I did put together just a basic farm scenario here. So here we got the land, buildings, machinery, crops, and the home fair market value of $10,700,000. The basis at the date of death, and we see a lot of this with real estate, if they've owned it 20, 30 years, a lot of buildings depreciated out, machinery depreciated. So in this particular case, the basis at death is $940,000. If this was a case where they, like Wisconsin community property state, everything stepped up, the surviving spouse would now have a basis of $10,000 or $10,700,000, and all those buildings, machinery can all start to be redepreciated again. So this is huge. So one of the ideas that was going to throw out and still is throw the stepped up basis out of the equation we're back to that surviving spouse having that original basis at death. And we're talking some pretty tremendous tax consequences. And unfortunately, quite a few of our clients aren't debt-free at death. And so not only have the debt that is remaining, but they're going to have the tax consequences to take care of. And there was a couple different scenarios, and that was all the hype all summer. And Kristine's going to talk a little bit more about that. And so I also do want to talk a little bit about the difference between inheriting versus a gift. So the basic estate and gift tax exemption, for 2021 is $11,700,000, and it adjusts for inflation. So as it stands today, this was the sunset in 2025, as Paul had mentioned. You do need to watch your specific state tax because every state has a different level, doesn't necessarily follow federal. And the other difference here on this is the step up in basis for inherited property, again, receives that step up. And again, real huge. Current rate is 40%. And again, you file a 706 form basically to document this basis. So if you ever get questioned by the IRS, you do have something to fall back on. So for most of our states today that we deal with, it's 23 million. But as you all know, the value of land keeps going up, and it's starting to probably push that limit for some of these people. And then the last item to cover here is a gift tax. The difference is on the gift is basically you can do the $15,000 a year per person that you can do. If you go over that, this means you have to file a Form 709 gift tax return. You still get to have the freebie $15,000. So if you gave the $20,000 to your son or daughter, you basically have $5,000 that would go against that $11,700,000. And again, carryover basis, however, for a gifted item is the basis that you have in the asset at the time. So if I have a raised cow, it's worth $1,800, and that basis is zero. So if I give that cow to my son or daughter, they're going to have a basis. The value is there, but the basis will be zero. So when they go to sell that, they will have that full gain. So there's quite a difference in the fact that getting a gift versus inheriting something. And the other difference there is that they were talking about doing away some of the discounting we can do with our entities on the farm. And that will be another big item that if we aren't able to take this 20 to 30% is quite common of a discount in an LLC or a family corporation to go against this exclusion. So with that, I'll turn that over to Paul again.
Thank you. Thank you. Our next speaker is going to be Kristine Tidgren. Kristine is an adjunct assistant professor in the Agricultural Education and Studies Department and the director for the Center for Agricultural Law and Taxation at Iowa State University. Kristine's work focuses on studying and interpreting laws impacting the agricultural industry, particularly agricultural taxation. We are delighted to have her join us today to share her expertise. Kristine, I'll turn it over to you.
Thanks, Paul, and thanks, Eric, for that great overview. And Martha, if you just want to move forward to where it says proposed capital gain tax reform, what I'm planning to do today is just to sort of give you a little bit of insight into the evolution that we've seen really over the summer in terms of what the opening bid was with respect to tax reform, how it has evolved. But it's really important, I think, as Eric and Paul both mentioned, to understand what the goal is of this tax reform in terms of the idea that the administration put forward in the spring when it set forth the American Families Plan, is what it was called, was that they were seeking to raise revenue so that they could implement the human infrastructure plan. So bottom line, we're looking at proposals to extend the child tax credit, these advance payments that have been going into people's bank accounts every month, to expand credits for families that need childcare, leave for families, paid leave for families, expansion to Medicare, maybe in terms of drug, proposals for vision and dental. Those are the benefits that they want to put forward. but they need to pay for it some way. But really a second prong of this has been the desire with the majority party to reduce what they call economic disparities among Americans, really to sort of equalize the way that wealth is taxed. And so one of the places that was sort of ripe for ripe fodder was capital gain, because historically, since really the beginning of our system of taxation, you have appreciation of property, and you don't pay tax on that unless you decide to actually cash in, unless you decide to actually sell that property. Well, what that has resulted in is we do have billionaires and millionaires who don't really pay much tax because they don't really take in a salary, so to speak. They can borrow against this massive amount of wealth and have a large amount of wealth, and they don't pay any tax. And so the idea was, how could a system or our tax system be reformed to tax that increase in asset and get that to be able to use that for these benefit plans. So that's sort of the background in terms of the support that has been on Capitol Hill amongst lots of legislators for a new system that would tax capital gain in a different way. So if we go to the next slide, we see that the president's proposal, and so I'm right now talking in sort of the opening bid, just so that everyone is on the same page in terms of what these proposals have looked like and where we're at now, maybe with respect to not getting a couple of senators on board, so what that means. There were really sort of two prongs to this approach of changing the way that capital gain is taxed. So the first fundamental principle that we've really had with capital gain is that it has had a preferential rate. And so we've really had a top rate of 20%. For passive gain, it has had an additional 3.8% tax. So 23.8% maximum tax really is where we've been on the federal side. The president proposed to eliminate that preferential capital gain tax rate so that if there was gain over $1 million, it would be taxed at ordinary income tax rates. The proposal also said we're going to raise the ordinary income tax rate to 39.6% instead of 37% that we got with the Tax Cuts and Jobs Act. Plus, as Paul referenced, a proposal still on the table would be to also add 3.8% net investment income tax on all business income, not just the passive income. So essentially what the president's proposal would have done is had a 43.4% tax on all capital gain over $1 million. And so if we go to the next slide, we can see what that would look like in terms of the impact. So we ran some data that we have just strictly in Iowa with land values. We don't have data on all farm assets, but we do have data on all farmland. So we ran the data on all of the farmland with the estimated basis generated from survey data. And so on average, we estimated that this plan, taking into effect the $1 million exemption and all of that, an average full-time farmer owning 358 acres of farmland would have seen tax liability from a sale, if they sold their land during their lifetime, increase from $475,000 to $860,000. So an 80% increase, up to 26% of fair market value for the sale. Okay, this was just a rough estimate of how this increase in tax rate on capital gain would impact a sale. So you can see right there, and we don't have a lot of farmers that are selling their land as it is, because 20% top capital gain rate already kind of prevents that in a lot of cases. But you can see that if you get this type of capital gain rate, people aren't going to sell assets, they're going to hold on to them. So the thought is, well, if we increase the rate, we're just going to have lockout effect and nobody's going to sell anything. So if you go to the next slide, that generated the next need, or the second prong of the plan, is that, okay, if we're going to increase rates, we're going to also have to couple that with some sort of forced recognition event, or else everyone's going to hold on to their property and never get rid of it. So what the president had proposed was, beginning in 2022, treat the transfer of appreciated property at death, or if you chose to give it away during your lifetime, as an actual realization event, meaning you treat it as though you sold it. Now, they were suggesting several exemptions. One is that you would have a $1 million exemption per person. So you would not have to pay gain on $1 million, pay tax on $1 million of that gain. But above that, you would have to pay capital gain tax just for having owned that property at your death. And this is separate and apart from the federal gift and estate tax system. So different tax, supplemental tax. If you go to the next slide, we'll sort of also discuss what that would have meant, or how that might have impacted family farms or farming businesses. So along the way, all throughout the proposals, was sort of a general suggestion or a general promise that we would have a deferral for family businesses, including family farms, meaning that at death, the farm assets would be subject to a calculation of this, maybe called transfer tax or capital gain tax, but it would not become due and payable, assuming that probably some narrow definition categories were met in terms of you're transferring it to other family members, presumably your ancestors, presumably not nieces and nephews and all those other assortment of potential relatives. But if you were actively farming, you transfer it to your children who are actively farming, then the suggestion was there would be a deferral of that tax, not an exemption from the tax, but a deferral, meaning, if you go to the next slide, that if you go back to what Eric's case study example said, the president's proposal would give you a $1 million tax-free step-up basis for everyone. But after that, the active farmer might get a deferral. So there would be sort of this tax liability hanging over the farmstead until such time as that property was sold or someone stopped farming it full time. We don't know, we never got the details in terms of what that proposal would look like. But bottom line, we wouldn't get that step up in basis that Eric talked about. And as he mentioned, there's a lot of debt that might be associated with some of these assets. You wouldn't be able to start depreciation back up again. It would just really significantly impact the cash flow of a farming operation, even if that tax bill was not actually due and owing. So a lot of concern about how that would impact active farms. If we go to the next slide, we just look at a little bit of example in terms of what a number might look like in terms of typical farm tax liability. So our numbers that we ran just for Iowa farmland, and of course there's so many more farm assets than that that matter. The proposal was never really clear about how machinery would be treated. 1245 property, we call it, wasn't really clear, but 1231 property, all that gain, no step up in basis. Here is an example just using farmland because that's the data we had. So an Iowa farmer from Buena Vista County dies in 2021, owning 700 acres of farmland. In 75, he purchased the land. It was $1,450 an acre, or $1 million at that time. Now in 2022, it's worth $9,800 an acre, which is fairly low, but that was the actual value at the time we did the study. He dies with $5.8 million in unrealized gain. He gets a $1 million exemption from the tax. Under the AFP, the farmer's death created a new tax liability of at least $1.8 million. And again, 27% of the fair market value of the land. If he's passing that down to a relative who's actively farming it, the proposal would have supposedly not required that tax to be paid, but it would be a liability over the land, impacting his lending, impacting his ability for other assets to depreciate those assets, etc. So there was a lot of concern in the farming sector about how this proposal would impact things. If you turn to the next slide, I want to just quickly look at how the House proposal has changed things. So as Paul mentioned, the House Ways and Means Committee is really the first look that we got at actual legislative language. And I think that a lot of House members were concerned about the impact of realizing capital gain at death and the concern that that would happen. So what the House proposal set forth to do was to raise the capital gain rate, but not to ordinary income tax levels as the president had proposed. But one difference was the president had proposed to raise the capital gain over $1 million. Here, it would just be the top rate would transform from 20% to 25%, plus, as Paul mentioned, the 3.8% what we call net investment income tax would really apply to all business income. So 28.8% would be the top capital gain rate, and it would kick in at $450,000 for married filing joint, the top tax rate. But there would be no recognition of gain or death at gift, at death or gift. And I think part of the equation with economists, when they go in and they try to crank the numbers and they try to figure out what is that sweet spot, how high can we raise capital gain where we don't have that lockout effect, where everyone will just hold on to their stocks is kind of what they're looking at, and never sell anything, because again, it won't generate any revenue if you raise it too high and everyone just holds on to everything. Also, another significant aspect of the House proposal, as Paul mentioned, was to lower the estate and gift tax exemption 4 years early. Now, this is the whole other system that we've had in place since the 20s, where we tax estates at death based upon the fair market value of that estate. But we've had significant exemptions that have really made it so that the vast majority of average farms are not subject to the estate and gift tax under current exemption levels. If you could go to the next slide, we'll sort of look at where we've been. And many of you have lived through times before this chart even where the exemption was at $600,000. And there have been lots of strategies over the years in terms of A-B trusts, ABC trusts, all kinds of things before we had some other changes in law that made things a little simpler. But you can see historically the values of the estate tax exemption, which is the amount of property you can own at your death and not owe any tax, has risen, so that, as Paul mentioned, in 2021, we're at an $11.7 million exemption per person. And then if you're married, portability allows you to share that between the two of you. So it's a fairly significant exemption. Right now in 2021, it's estimated that 0.16% of farm operators would owe any estate tax under current exemption levels. That's 0.16%. Also, the numbers that we had back from 2016, let's look before the Tax Cuts and Jobs Act sliced the exemption or doubled the exemption amount. So we were at a $5 million exemption at the time that the Tax Cuts and Jobs Act doubled that. And during that time, the numbers from 2016, there were 5,219 estate tax returns filed for taxable estates during that year. And of those, only 682 had any farm property. And that's 2% of total taxable, it should say estates, not assets, sorry about that. So 2% of total taxable estates had any farm property at all. So even at $5 million at that time, now land values have gone up since then, asset values have gone up, but they, not a terrible high number of farmers were impacted by the estate tax at those exemption levels either. Now, if you go above that amount, if you go above the exemption amount, the estate tax is high. It's 40% of the value of your assets above the exemption amount. And it's a flat rate at that point because everything's just taxed at 40%. So that's, the proposal is to go back to the $5 million exemption indexed for inflation, which would be roughly over $6 million. So that's what's on the table right now with the House Ways and Means Committee. As Paul mentioned, the latest proposal out of the Senate is maybe just a mark to market, which means year-to-year tax on the gain on billionaires, and he calls it a Trojan horse, and I definitely understand what he's saying there. You sort of get a system in place, and then it's not very hard to turn the dial and dial it down and say, well, now anybody with $5 million of assets or $10 million of assets or $2 million of assets is now subject to the same tax. Now, the interesting and difficult thing about implementing the mark to market, and what's different about that from the president's opening bid in terms of taxation, just the taxation of gain at death, is the fact that you would also have to account for loss. So interestingly, you would maybe get taxed on the gain in a particular year, but then if things tanked, maybe you get a deduction for losses. So it's a very complex system. We're just all sort of watching how all this will evolve. But I just wanted to sort of distinguish between capital gain taxation, estate taxation, gift taxation, and how those two are different. And since we've seen both being proposed. So back to you, Paul.
Thank you, Kristine. I think we already have some questions that have been coming in. We're going to hold those until after our next speaker. We'll have one more speaker here. So our final speaker is going to be Dustin Sherer. Dustin is the Director of Congressional Relations for the American Farm Bureau Federation. Prior to joining the Farm Bureau, Dustin served the last 10 years as a staffer in both the House and the Senate. So he has a good idea what's going on and how it's working behind the scenes. He was working for Senator Cory Gardner and Congressman Scott Tipton, where he served as a legislative advisor specializing in agricultural, energy, environment, natural resource, water, and tax issues. Dustin, I'll turn it over to you.
Thanks, Paul. Happy to be here with everybody today. I thought I would give a little bit of a overview on just why we're having this discussion. Kristine did a fantastic job of covering some of the specifics on the spending side of things, what they want. But I'm just going to talk a little bit about process because more than some of the recent exercises that they've gone through, the process on this is muddled, difficult, and also very it'll be a big part of where we end up. The reason that we're talking about taxes is because the Senate and the House, after a long negotiation, adopted a budget resolution for $3.5 trillion in spending. And again, Kristine went over some of the stuff that they want to spend that money on. Importantly, it authorized all of the non-tax writing committees to spend amongst themselves about $1.75 trillion. What directions it gave to the tax writing committees, it said you essentially only need to raise $1 billion over the next decade. The reason that this is important is that all that the tax writing committee is required to do is anything that it spends money on within its jurisdiction, it has to raise the revenue to offset by $1 billion more than it spends. So if they want to issue a bunch of clean energy tax credits, they need to pay for it by either finding an offset or raising taxes. If they want to pay for paid family leave, they have to find another offset or raise tax revenue, and basically just net out their spending. The political pressure that Capitol Hill is feeling right now has required them to message that the entire bill, though, is fully paid for. And so in addition to just paying for their spending, Ways and Means has looked for offsets to cover the other $1.75 trillion in other committees' jurisdictions. So after the Senate was the first to actually pass the budget resolution, they wrote the budget resolution and passed it. We expected that they were going to have the first swipe at crafting legislation, and instead the House was actually the first ones to take a stab at crafting the bill. Next slide. Thank you. Without getting in too many of the details, a lot of which have already been covered, they came out with a bill that raised roughly $1 trillion in the corporate tax. It raised roughly $1 trillion on the individual side of the tax code. It raised $100 billion in tobacco taxes, and they expected to raise about $100 billion from increased revenue from IRS enforcement. The big offsets in the plan were a repeal of a drug rule and the imposition of drug price negotiations, where they expected to save $700 billion from those. And then they put in place a dynamic score for this bill where it said, when you put all of these policies in place, we expect GDP to grow so much that it will generate an additional $600 billion in tax revenue over the next decade. And that's where you get to the $3.5 trillion number. Now, recently we've seen a couple things that are notable when we look at this. Senator Manchin has come out in opposition to the IRS reporting requirements, which were a fairly large non-tax pay for. And additionally, Senator Sinema has opposed the House version of the drug price negotiations, in addition to the fact that they had some House members vote against that advancing out of committee. And so some of these non-tax revenue offsets that got them to 3.5 have run into issues. And the problem that they face is, even if the top line spending number of $3.5 trillion is shrinking, the more that these non-tax raised revenue sources fall off, the more pressure it puts on them to raise revenue in the tax code. Next slide, please. So this is a rough estimate of how much revenue would be raised based on the House version of the Build Back Better bill. Their proposed top corporate rate would be $540 billion. Capital gains tax changes. In the House proposed version, they'd raise $123 billion. The changes that Kristine went over in the American Families Plan, which included subjecting them above $1 million to the top rate, upping the top rate to 39.6, and the imposition of a transfer tax would have raised $323 billion. So when she shows you numbers of the liability for an average family farm doubling, that's where they're raising massive amounts of money, $323 billion. So that's very accurate. The imposition of these surtaxes, $252 billion. The increase from 37 to 39.6 in the top individual rate, $170 billion. And you can see as we go down the list, 167, 78, and importantly, the changes to estate tax, grantor trust, and valuation rules that were in the House bill, $77 billion. So important to note, again, that changes to step-up basis and the imposition of a transfer tax were not in the House bill. But again, it's hard to feel good about any of that when some of these other non-tax revenue pay-fors have fallen out of the bill, and they continue to look at ways to raise revenue to pay for the bill. Next slide. And just from a practical application standpoint, we ran an analysis when we saw the inclusion of the accelerated expiration of the enhanced estate tax exemption and what it would mean for the number of farms and the acres operated in terms of having the estate tax apply to them. So as you can see from this, going from where we're at under current law and reverting back to where we were prior to the Tax Cuts and Jobs Act, it would more than double the number of farms that are subject to the estate tax. And it would capture roughly 68% of farm acreage that's operated. So I'm definitely going to be the shortest presenter of the group because there was a lot of detail in front of me, but I'm happy to answer any questions. Paul, I'll kick it back to you.
Okay, let me get set up for a little bit of housekeeping. Again, thank you, Dustin. Thank you, Kristine. Thank you, Eric, for all the presentations here. We're going to go ahead and kick off our Q&A session. I see we already have a few in here. I think also if we start slowing down on some of the QA and it finally dies off, we'll go ahead and terminate the session early. But I also will have some questions for the panelists. And the kicker is they don't even know what the questions are right now. So we'll see what happens here. But I'll go ahead and And I think what I'll try to do is, based on the question, I may kick it over to Kristine or Dustin or Eric, just depending on the question. And then I will also add in some commentary. So first question: how is the current uncertainty over congressional action impacting producer tax planning and spending? I think, Eric, I'll start off with you. You deal directly with a lot of farmers out there that are preparing tax returns. So let's go ahead and start with you, how it's impacting at least your farmer base.
So right now we're seeing quite an uptick, and with the nervousness all summer, we just had a lot of clients calling us, and a lot of them are actually moving ahead. Talking to some of the attorneys we work with, they're so worried about this gifting maybe being decoupled, and so if they're sitting with a sizable estate, they're actually getting some of this land moved. So we're real busy right now working with some of these clients and getting some of the assets moved in the event that this actually goes through. So I guess in worst case scenario, if it doesn't go through, it's maybe force some of these people to finally do some transitional planning that you should have been doing for the last 5 years. So
yep. Yeah. Okay, Kristine, I'll kick it over to you, and then Dustin and I will also have you just chime in a little bit based on what the American Farm Bureau has been hearing from their members. But Kristine first, and then Dustin's second.
Yeah, I would just echo what Eric says. I'm just hearing from my practitioners out there that it's just really hard to advise. There have been a lot of people also looking at if they have a grantor trust, or they have an opportunity, maybe a tiny little window where they can get something into a grantor trust while it's still available. There have been some looks at that as well, but these are all very complex provisions, which just makes it even harder to know how to advise clients.
Okay, and Dustin?
Frustration. I think it's important to note that Tax Cuts and Jobs Act was the first comprehensive tax reform that had been put in place in over 30 years, and there's a reason for that. It was the culmination of 7 or 8 years of Republicans holding hearings, fleshing out a lot of ideas, looking at the tax code, and putting into place things that have been fleshed out. And 3 or 4 years later, you're now talking about very significant changes to things that have been worked on for quite a long time, that people started to build business plans and transfer plans around. So frustration is what we're hearing.
Yeah, and I would echo all those answers. I know that we have people continue to ask, hey, what do we do? And it's frustrating on our end to say, we don't know. I mean, probably the worst thing we can tell you to do is to do something right now. And I guess I will echo that a famous American philosopher, Aaron Rodgers, when he was asked a few years back after losing 3 games in a row, he told everybody to RELAX. So I am telling a lot of our producers, relax, we'll be able to deal with this. It's not that draconian, so we'll be able to figure out a way to fix it. And I also tell people, this is one administration's ideas. If we get a change in administration that goes back the other way, it'll likely get changed. But again, that can create issues, because now we're starting to get whipsawed. One administration comes in, changes what the other administration did. And like Dustin had said, we had 30 years of building up to where we needed reform. We got the reform. We thought it might last for another 20 or 30 years, and it's barely lasted for 4. So, or potentially has only lasted for 4. So next question. I'll probably kick this over to Kristine first. So what is the definition of an active farmer? Does this include a landowner that does not actually drive the equipment, but jointly makes decisions with the farmer and has a crop share? So I'll kick that to you, Kristine.
We don't know is the answer. If you're talking about the president's proposal with capital gain, we never received definitions. We never received legislative language. And if you're familiar with the tax code, it varies depending on what tax provision you're looking at. So again, very unclear. We did not have clear answers on that. Good question.
Yeah. And again, the House proposal would increase the 2032A up by almost a factor of 10. It's currently about 1.2 million. It would increase to 11.7 million index starting next year. And under that definition, it's pretty restrictive. I mean, cousins don't qualify. Certainly crop share might qualify as long as it's being farmed by a family member. And again, cousins don't qualify. So, there could be some issues there. Eric, I'll let you chime in if you want to on that one.
Yeah, I guess I would agree with both of you. Pretty unclear at this point, and a lot of people don't understand, all these attribution rules and as far as relation, what qualifies. And unfortunately, there's different rules for different credits and stuff like that. So it makes it really difficult.
Yeah. And speaking of, the credits, so we have the employee retention credit, and, for over a year, everybody was assuming that, S corporation owners could pay wages to themselves and qualify for the credit. And then IRS finally came out and said, time out, you guys are relying on our frequently asked questions. Basically, under their breath, they're saying that was a stupid answer we gave. Here's the real answer, so I'm adding a little commentary there. So next question. How's the discussion about the proposed capital gain reform tax different from the proposal to eliminate the stepped up basis? So again, Kristine, I'll start with you. I may kick, if Dustin or Eric want to add in, go ahead. I will also add in some stuff at the end. So I'll start with Kristine first.
Yeah, that's a great question, because there's just been there's a lot of confusion when you talk about stepped up in basis in terms of what you're even talking about, because step up in basis is that adjustment of basis at death under what we call section 1014, which is at death, it's adjusted to fair market value. That's the way the current system works. The president's proposal would have eliminated the tax-free step up in basis for anything over $1 million. So if you had $1 million of gain, you would still get a tax-free step up in basis to $1 million. But anything over that, if you were not subject to the family farm deferral, which we never really understood what that was going to look like exactly, you would get a step up in basis, but you were going to have to pay for it because you were going to have to pay tax. And when you paid the tax, the basis would step up. And what Paul has alluded to is we still don't know, even if they eliminate the transfer tax, there's a likelihood that they could say, well, we're giving you that, so we're not going to have any more tax, we're not going to have any more step up in basis, period. So you're going to have, a $10 million exemption, whatever, maybe, but you're also not going to get that step up. So we're back to Eric's chart with those farm assets that are down here in the gutter with no depreciation, no ability to get loans, borrowing against those assets, et cetera. So it's confusing in terms of the way headlines say, eliminate step up in basis. Yeah, that's true. But really what the president was saying is eliminate tax-free step up in basis. You would have got your step up. You just would have had to pay for it.
Yeah, and again, Dustin or Eric, it looks like Dustin maybe wants to chime in here.
Yeah, I agree with everything Kristine said. I would just say that, so in the House bill, they take the statutory rate from 20 to 25% on capital gains. The original proposal, as she referenced in the American Families Plan, it was a revenue maximizing proposal, right? Because they were going to subject capital gains to the overall top rate and then eliminate the tax-free step up in basis and then institute the transfer tax. And that was like the revenue maximizing reason to look at that as a whole concept. When they realized that there was pushback to the effective elimination of step up in basis, they fell back to just turning the knob on the existing capital gains statutory rate, because they knew that there was just a lot of revenue they weren't going to be able to touch, and it was an easier dial to raise revenue that way.
Eric, do you have anything to add?
Yeah, just in regards to that, the NIT tax, when somebody mentioned the capital gains, right now farmers have the ability to sell land, and as long as they're active farmers, not having to pay that 3.8%, that's one of those proposals that farmers would no longer be exempt and all ordinary income would be subject rather than just investment income. So 3.8 doesn't sound like much, but when you start selling some of these big farms, you're talking some real dollars.
Yeah. And I think the only thing I would add is just give a little bit of a history on step up in basis. It's been around for quite a while, but we had a period during the mid to late 1970s where we didn't have it, and then it sort of retroactively got reinstated. A lot of commentators out there say, hey, we have to have step up in basis because we don't know what grandpa paid for the land 45 years ago, et cetera, et cetera. But we have to realize in today's environment, all of our stocks and bonds held at a brokerage account, we know what the basis is. the S corporation the farmer has, the partnership the farmer has, we know what the basis is, or we should know what the basis is. And the proposal, the STEP Act proposal, if I remember right, had a provision that said that if you didn't know what the basis was, we're going to take what is the sales price or the fair market value, when was it purchased, and we'll just discount it back using some type of a factor. So just the idea that we've always had step up in basis is not correct. Now, again, we had a period there where sort of it got canceled, but the step up in basis is not necessarily a right that we're subject to. It's a privilege. In dealing with tax code, anytime we have a privilege, it can get taken away. So let's go ahead and get to the next question. Okay, so Paul, you had mentioned that December is a likely drop dead deadline on this. What does everyone think if we don't get a deal by December, that it won't get done as 2022 faces more election impact? So Dustin, I'll start with you on that. That's more of a political question.
Sure. I think that there's some things that might happen in between now and then that could very well dictate whether or not this thing continues to move forward or just kind of blows up. And one of the things is the governor's race in the state of Virginia. If a state that President Biden won by, I think it was 13%, all of a sudden elects a Republican governor, it's going to cause a lot of introspection, I think, on Capitol Hill, given that they are trying to pass a president's agenda who is now all of a sudden seen as an anchor around candidates at the top of the ticket. And so one of the reasons they've been pushing for this particular deadline of October 31st was trying to get this thing across the finish line before the election. I mean, technically we're voting already, but the election's on next Tuesday. So I think there are some things that could happen in the meantime like that may dictate, that may have a say on whether or not it gets done. On the other hand, a lot of this seems to be just House and Senate leadership trying to keep the plates in the air until they can figure out a way to get the bipartisan infrastructure bill on the floor and passed, and then, let the chips fall where they may on the larger package. If they can't figure it out, they can start pointing fingers. I would say that jet fumes in December are especially potent for members. Nobody wants to be there late. Everybody wants to go home. Everybody's tired. Everybody's burnt out, and they want to get things done. But there are some things before then that could happen where we may or may not even be having that conversation in December. My guess is if they don't get it done this week and it doesn't look like we're going to have any type of vote, they probably patch the highway program to either December 3rd or December 31st. December 3rd is when the CR funding the government runs out, and they try to just put in place another forcing mechanisms to get something done.
Okay. I would open it to Kristine or Eric if they want to chime in. Again, that was more of a political question. We got plenty of questions, so but if you want to chime in, just go off of mute and let me know, and we'll go from there. Going once, going twice, we'll kick it on here. So here's a good question, and I think all of us can chime in on this. How do the pending tax law changes impact owners' decision to sell land now or wait for future gains? What I can tell you, I was talking to Sherer, who's one of the owners of People's Company, based in not too far from where Kristine is at, based in Des Moines area. Last year at this time, they may have had 15 land auctions scheduled between now and year end. I think right now they have over 100. It might be close to 150 land auctions scheduled. Now, partly that's because the price has gone up. It isn't just purely based on tax law changes, and I'm well aware of that because I bought land in Iowa last year, and I could double my money right now if I wanted to. So, but I think Kristine, I'll kick it over to you, then Eric, and then perhaps Dustin if he wants to chime in.
Yeah, Paul's right in terms of the increase in value. Just 20% over a year's time is sort of the increase that we've seen. And again, all these things are volatile. And that was one of the concerns we've had when we're talking about we're going to tax your appreciation at death, because yeah, maybe some number right now when I die, I've had this much gain, but if I would have died a year later, maybe I would have had this much gain. So that sort of is a good illustration. But in terms of getting sales before the end of the year, one of the interesting things is capital gain rate likely going up. The date on that, though, is in the House Ways and Means Committee, that the increase in the rate was September 13. So, I mean, we don't know what date any increase in capital gain would kick in, but that's a factor.
Eric, any comments?
Yeah, I just agree with Kristine that, they've already missed the bus, the September 13th that this thing goes through. So some of these people that all of a sudden think they want to get to, they've already passed that date if that's what really happened. So I guess, some of these are just looking at some super inflation here too and capturing that. So that's probably, like you had mentioned, why some of these people are looking at, let's cash in, no different than if you owned a stock or a bond. So.
Dustin, any comments?
No, I was just going to echo what Kristine said. I mean, they did their best to, retro date that bill so that they could capture anybody that was trying to get ahead of the increased rate by saying anything that happens between bill introduction and this getting signed into law, you're gonna pay capital gains on the increased rate, which I don't know. I think there might be some suing over that one, but
well, it's gone through court that they can do retroactive, and actually they announced it, so it's really technically not retroactive. We know in tax reform bill, 100% bonus was allowed for assets placed in service after September something. I can't remember the exact date, 23rd or somewhere in there. So there is the ability for doing that. So our next question, now we're dealing with partnership discounts, and this is a good question. Hearing that we'll eliminate that discounts will be eliminated for portfolio, the investment type partnerships. Will this also apply to business partnerships, i.e. family farm partnerships? So let's start with, I'll start with Dustin if he has any comments, and then I'll probably kick it to Kristine and then Eric, and certainly I'll throw in something if I need to.
All I know is that we're hearing more and more about this particular issue especially from, if I'm understanding correctly, farmers who own land and then lease it out. It presents a pretty significant issue. And I'm sure the others can go into a little bit more detail on that.
Okay, Kristine?
Well, the only thing I'd say is that the language does narrow it into assets not used in a business. So I think it would kind of fall onto what is that definition? What does that mean? How broad is that? And I don't know if you have thoughts on that, Paul.
Oh, I will, but I'll check with Eric first. Anything to add, Eric?
Yeah, like I mentioned, my presentation, we've had quite a few of these limited liability companies, partnerships, mom, dad, and son, where we've been able to discount as we transfer that, and that's just less to go against their lifetime exemption amount. So it would amount to quite a bit on our smaller size family farms, where we've been able to take this market adjustment, so to speak, and lower the amount that we're going against that future exemption amount.
Yeah, I think what I've seen just reading the actual bill is they are fairly specific that it applies to all rents. I mean, it sounded like that was what the intent of the bill was. Now, does that mean we then, because for the last 20 years, we've gone out of our way to separate the farm operation from the land holding operation or the land holding entity. If this goes through, does that mean we now collapse the land back into the farm? And then in that case, it would be subject to the discounts. Wait and see. Now, again, I'm a firm believer that if Cinema stands strong and we don't get increases in tax rates, either the corporate or the individual, likely all these proposals on the grantor trusts and all this other stuff, the discounts is likely going to go through. It's the only way they're going to raise some money. So it's sort of a wait and see. Okay. So what are your thoughts on what this might do to asset valuations? Hence financing and the financial fabric of production agriculture if these things go through. I'll just open it up to anybody that wants to unmute. I'll let them go first. Nobody wants to go first, so.
I'll just say I rely on my economists for those predictions and I try to stay out of that.
Yeah, The one thing I would chime in, there was an article or an opinion in the Wall Street Journal a couple of days ago how the proposed changes would devastate real estate values. And they were going back to the tax reform of 1986, how the major changes in tax reform where you couldn't really deduct real estate led to the savings and loans crisis. They were talking about, I don't think that would be as devastating as maybe 1986 was if these things go through. I think what's more devastating to real estate values if interest rates double or triple. That's going to be devastating to ag land real estate values more than I think these tax proposals, especially the House proposal. You know, if the top rate is 25 versus 20, I mean, I think we can live with that because they still allow unlimited 1031 exchanges. Farmers are still going to be able to exchange their farmland, and that's typically when they sell farmland, they want to exchange it for other farmland. So I'm not as concerned. But again, as Kristine said, I'm not an economist, although I stayed at a Hampton Inn last night, so maybe I qualify, but I don't know. Eric or Dustin, if you want to add anything. Okay, here's a good one. Any insight on the employee retention credits getting eliminated for the fourth quarter of 2021? I'll chime in on that. As we know, the what I call the physical infrastructure bill that was passed by the Senate, it's sitting at the House, has a provision indicating that the ERC, the employee retention credit, is eliminated for the fourth quarter, unless you're one of these qualifying startup businesses. I may not have the exact terminology, but it's pretty close. Now, we're already almost a full month into the fourth quarter. People are relying on what the current rules are. If that gets passed by the House, and I had a podcast with Colin Peterson a couple of weeks ago, and I asked him about this subject, although I'm not sure if it got in the podcast, but I know I asked him, and his feelings were that likely if the physical infrastructure bill did get passed as is, then in the human infrastructure bill, they would probably have a provision that would bring it back in. It's going to be difficult for them to outlaw something that we're already a month or 2 months or almost 3 months into the quarter. So I'll open it up to anybody else to chime in on that.
All I'll say is that I know the business community, NFIB, the chamber, and others have been engaged with lawmakers up on the Hill on that. So it's on folks' radar.
Okay, perfect. Okay, so oops, these questions bounce around on me. So is the estate value discounting for lack of control or minority interest in LLCs or sub-S corporations potentially being limited or eliminated? So, you know, maybe Eric, start with that, and then I'll kick it over to Kristine.
Yeah, from what I had, interpreted from that, it sounded like it was going to be eliminated. So it would be no more adjustments for that marketability and saleability. So,
Kristine?
Yeah, that's that provision we were just talking about where the language is a little bit unclear to me in terms of exactly how broad it is, but definitely those are targets. I mean, we had regulations that were proposed before this, before the last president that would have really done in these discounts. And so I think they're always sort of on the chopping block potential. And so we'll just kind of watch and see.
Yeah, currently if it's a active trader business, supposedly the discounts are still there, but then if you own a minority interest, is that going to qualify? As everybody says, nobody really knows for sure. So here's a question. It's more of a technical question. Maybe I'll kick it to Eric first. How is the basis figure when land was inherited from an Irish family, farmers that settled in the country in the 1800s? So
well, as long as if the step up stays, we'll get the new value. It'll be appraised. So, so that would be the good thing. Now, the other extreme, yeah, I guess I'm whatever the basis was originally when they bought it is what you're stuck with. So,
yeah. I think the one thing we need to be, and I'll ask the commentators to comment on my. Remember the STEP Act, and there's a couple other acts very similar. We have all these people that are putting their assets into grantor trust or into trust now because they figure it's going to be grandfathered. But the reality is that likely these trusts either later on or some point in time, they either because they're trying to do dynasty trusts. You know, South Dakota allows you to put in trust for 1,000 years. But Congress says, we want that estate tax to be owed, or a step, we want you to pay tax every 20, 30, 40 years, whatever it might be. I think now that's not going to make it in this bill, but I think eventually that's going to happen. So, you know, we just have to realize dynasty trusts sound great in theory, but the practical matter is a lot of them have a lot of issues. So I'll just open it up to any comments anybody wants to say on that while I look at the next question.
Yeah, I would echo that. I would just say a lot of times we bend over backwards to save some tax in the future that we don't know if it's going to be imposed, and we're putting a lot of restrictions on ourselves during our lifetime. So just weigh the benefits and the risks, weigh the risks really carefully before you just dive into something for future potential tax increases.
Okay. At a strategic level, in light of the proposed changes, should a larger multi-generational farm business be considering moving from LLCs taxed at the personal level to LLCs taxed as corporations? And of course, my answer is going to be, it depends. You know, that's really going to be the answer. But I think if they really do increase individual rates, yeah, we definitely need to be considering C corporations and so on. But I'll open that up for anybody.
It's kind of interesting because we've actually been converting the last few years C corps to S corps, partly just because of some of the credits, the 199A, you don't get it at the C corp level. And if you're a dairy producer and you're getting a big kickback from your creamery, that's a big amount of a deduction you're losing. So because of that, even though the bill was only through 2025, with the discount or not getting the fringe benefits like we used to with the C corp, we've actually seen quite a few people, a lot more interest going. We're converting, and especially if they have highly appreciated assets like real estate in their C corp, we're getting them converted to S corp so that eventually that land can be taxed at a lower capital gains rate, assuming the capital gains continue to be a lower rate than the standard rate. So
I guess I would just comment that sort of illustrates the problem with this whipsaw approach, as Paul mentions. I think there's a reason we have a filibuster in the Senate, and that really is to sort of prevent these ping-ponging laws. Entity selection is really meant to be a long-term event that you are basing on something that stays somewhat consistent. And it's really frustrating and unfair if from administration to administration, the whole foundation of the way entities are taxed. I mean, if they somehow keep changing, it becomes impossible to manage your business in an effective way. So that is the difficulty that we see with this whole budget reconciliation, which both parties have used. So it's not a political statement, it's just the reality.
Yeah. And I think the more I think about it a little bit, I think having a multi-generational in a corporation, not the land, but the actual farm operating, that might be the wave of the future, but we'll see. Dustin, anything to add on that?
No, I mean, I just, answering that question is going to require us to look at the totality of the changes that actually end up getting made, if they get made, right? When you look at where the top rate is going, like in the House bill, with the top rate going where it's at and the proposed changes to 199A, maybe the 26% corporate rate and the stuff that you have to deal with it on that side becomes a little bit easier and, on the pocketbook and just to deal with generally. But you can't look at any one thing and say, this is going to cause me to do that. We're going to have to look at the totality of the circumstances when this all gets done. And given that we know the only piece of legislation that we've seen, we know for a fact is not what's going to be voted on. It's just hard to answer that question right now.
And it even goes back to when we had tax reform, we were doing our projections as to looking, is it better to be a C corp? Is it better not to be a C corp? And of course, one of the major assumptions is how long is these rules going to be in effect? And that's going to be the same thing here. If we make a major structural change and 4 years goes by and we have a new administration and we got whipsawed the other way, it's just difficult right now. So now this next question is definitely for Dustin because it is purely political. So I'm warning you right away, Dustin. We already had a massive annual deficit in the federal budget before the new spending was proposed. How long can we continue running these big deficits without major tax increases, even without any new spending?
Oh boy. Look, we've got a problem on our hands, and it is we annually spend more money than we bring in tax revenue. This has been a problem for a long time, but over the course of the last 20 years, it's gotten really bad. Both parties, both sides, everybody's guilty for our current fiscal situation. To answer your question, I don't know how long we can continue on our current path. I'll give you some context for just how bad things are right now, though. Last year, the federal government, last fiscal year that ended on September 30th, the federal government brought in $626 billion more than it did in fiscal year 20. It was a 13% increase. It's the largest increase in federal tax receipts we've seen in a couple decades. It's the first time that the federal government has ever collected $4 trillion in tax receipts, and we still ran a $2.8 trillion deficit. So there are obviously all kinds of arguments about we're the reserve currency of the world and everything else, but if you look at the inflationary pressure that the economy is facing right now, it's not just supply chain issues. We have pumped a lot of money out into the country, and it's not a great situation, and it's not sustainable in the long run. So say that.
Well, Dustin, can't we just, create like 20 of those $1 trillion coins and have that take care of the deficit? Can't we do that?
At some point, you got to have somebody who's willing to buy it up.
Yeah. When I heard about the $1 trillion coin, I was starting to think of Zimbabwe or Germany between World War I and World War II. You talk about hyperinflation at that point. So I guess I'll get off of that tangent here. So let's go on to the next one. It looks like, it says I got a few more questions, but is my Q&A thing locking up here? Hold on a second here. Oops. Hold on a second. So I'll probably answer this one. Is the jump in the number of land auction schedule indicative of more land coming onto the market, or more that auctions seem to bring the highest prices over private treaty sales? Well, I think auctions certainly over the last several years have really probably come to the forefront. I don't think, that's not really a tax related question, but I certainly know that auctions are certainly more, they're out there more than they've ever been in the past. And as far as private treaty, there's still a fair amount of that. Typically, I would say it's more when the landlord has a great relationship with the tenant farmer and really just wants the tenant farmer to end up owning the land no matter what, is what I think. So let's go to the next one. Follow-up question to the elimination of lack of controlled discounting. Do we know what the effective date of that change would be? So Kristine, I'll let you chime in on that one.
I think it would be January 1st of 2022 is what I recall. Yes. That right? Mm-hmm.
Yeah, that's what I recalled too. So now again, that's a House proposal. There still has to be a Senate proposal, and then you have to have a reconciliation. Yeah, we're still, in a 4-quarter football game, we might still be in the first quarter. We feel like we hope we're in the fourth quarter, but we still might be in the first quarter. So, and here's another one I think for Dustin. The Fed still claims rising inflation is transitory and tied to the pandemic, supply chain bottlenecks, et cetera. But all that new debt is hardly transitory. Aren't the seeds of rising inflation already sown and can't be reversed?
Nothing, nothing's impossible. I'll just say that the fiscal situation right now is not great. It's not, I think it's hard to argue at this point that inflation is transitory. 5.4% in September, 5.3% in August. Most people projecting that it's going to last well into 2022, which is also, where we see a lot of the supply chain problems extending into. There's no question that like the pandemic and the supply chain bottleneck that has resulted are partially responsible for what we're seeing right now, right? We gave people a bunch of money, said don't have to pay your mortgage, don't have to pay your student loans. We cut people checks and then told them to stay at home. And all they did was shop on Amazon or whatever else. And so the demand for all these goods that were no longer getting made at the pace they were before went through the roof. And in the meantime, those factories overseas, aren't operating the same place they were. We're not moving stuff internally, domestically, the way that we were. So there's a lot of things that are contributing to it. But the $2+ trillion deficits when we're at the level of debt that we're at is unsustainable. And yeah, some of that is already baked in.
Okay. Right now we don't have any additional written Q&A questions here, so I think maybe I'll try to come up with a couple general questions for everybody to answer. So first question, how likely do we think we'll have a bill passed between now and year end? So I'll start with Dustin, and then I'll go to Eric and then Kristine.
Well, a bill, I mean, I'm fairly confident that they'll have to pass the bipartisan infrastructure bill before the end of the calendar year. As for a bill where we have tax increases that concern farm and ranch community, I'll say right now it's probably 6-5 and pick them. It's really up in the air. You've got a lot of factions that you have to satisfy, intra-party factions within the Democrat Party right now that you have to satisfy below this. It's going to be well below this 3.5 number that they passed in their budget resolution. So settling on that number, settling on what that number is going to pay for, and then settling on how you were going to pay for that is what they're currently going through. And here we are once again at the end of the month with the same place we were at the end of last month with really no agreement. Almost all of the tax proposals that we just talked about have been, well, not all, but many of them have been completely swept off the table. And one of the reasons that I'm a little bit more pessimistic maybe than some of the other ones is that when it comes to raising revenue, a lot of those previous proposals are the low-hanging fruit, right? Rate increases are a known quantity when it comes to raising revenue. Up to a certain point anyways. There are obviously levels where rate increases get beyond effective revenue collection rates. But all of a sudden, when you start turning to billionaire mark to market as a way to raise revenue, when you couldn't even raise the statutory capital gains rate, it makes me question whether or not they're going to be able to solve this Rubik's Cube. So.
Eric?
Yeah, I would agree with that. And I don't know if they've even figured out that debt ceiling thing, but when the Democrats, the pressure's been on to get this done. But it looks like they're getting closer to agreeing on things. So I am a little optimistic there, but at the end of the day, how are they going to pay for it? Because like Dustin said, they keep sweeping off all these things. So where's their magic bullet going to come from to pay for all of this?
And then Kristine?
Oh yeah, I've long ago stopped making predictions on this, but I would go back to your football analogy where you said we're in the first quarter. I feel like we're in the fourth quarter and both sides have thrown out the playbook entirely and they're kind of starting over, coming up with playbooks from scratch. When you're pulling out a whole new proposal at this side, when people have diligently been working for months on language, it's really interesting. So we're just watching.
But again, we might be in the fourth quarter, but I think we're going to be like that Penn State in Illinois game where we went into 9 overtimes and all they could never get a 2-point conversion across the line. So I think that's what the Democrats are right now, is they're trying to get a two-point conversion across the line and they can't even, they keep fumbling the snap. So that's what's happening. So well, so far, I don't see any more questions, and we don't have to go to the top of the hour. I think what we'll do is I think each of us will maybe have some closing comments. I didn't, so you have to put on your thinking hat here a little bit for a closing comment. I'll start off just because I didn't warn everybody they're going to have to do a closing comment. But my closing comment is that I think the assumption that farmers are safe from any type of transfer tax is good. But I think the assumption is that step up in basis is still going to be there when somebody passes away. I think that may become the low-hanging fruit that the Democrats may go after. I think it is, and the farm organizations know that the argument of, hey, we don't want the transfer tax because that's going to do an undue burden on us. But then the progressives, I'm going to call them the progressives, come back with the argument, well, then you really don't need step up in basis. You've told us you're never going to sell the farm. Therefore, why do you need step up in basis? And I think that certainly is out there. And that's probably my biggest concern, is that step up in basis still is not totally safe. You know, I think we think it's safe. Now, I think we're safe from the transfer tax, but I still don't think we're safe from the elimination of, or at least a partial elimination of step up in basis, especially if a farm partnership has negative capital accounts. I think Congress will certainly take a look at going after that. So with that, I think we'll go in the same order that we did at the beginning. So Eric, do you have any closing comments you would like to make?
Yeah, so all this anxiety that created for a lot of people all summer, you know, it's going to be kind of interesting to see if basically it's back to status quo, is the way it's almost looking right now. So the only positive I can spin out of the whole thing that I can see is it has definitely put the attention to our clients that maybe it is time to start doing some transition planning. And so if there is a golden lining to all this, I would have to say that, but it did put a lot of stress and still does. And especially when Congress starts making these tax law changes in January or February, retroactive, so we can't file a tax return. This is, I mean, in a way, it's just getting plain ridiculous and putting just a lot of added stress on the tax industry to take care of that. And for our clients doing tax planning, we have a great tax plan put together by the end of the year, and then they go throw a curveball at us, and the tax plan is out the window. So that's what I've got on that. So,
but remember, Eric, they don't care. So just remember that they don't care. Kristine.
Yeah, I would just go back to your earlier quote. I don't even remember who you quoted, but the RELAX, just kind of relax. We'll just watch and see what happens. It will be what it is. And you know, one interesting thing though, just to note is, you know, once some of these ideas that really haven't come to the forefront a whole lot over the past, you know, 50 years, they've always been in academic circles, but now they've sort of been put out there to the public. And so it is sort of a little chipping away of down the road, you know, these things aren't going away. So just watch and consider that as well.
Well, and Eric definitely knows who that famous American philosopher was. It's Aaron Rodgers, who plays quarterback for the Green Bay Packers. You definitely know that one, Eric. So, Dustin, any final comments?
No, I'll just sum up and say, you know, Farm Bureau's been in DC fighting against proposals that would harm the farm and ranch community. We're going to continue to push back on proposals that we think would be counterproductive or hurt the pocketbooks of our members, whether or not it's, you know, on an income level or a generational transfer level. We want farms to stay whole, stay in the family, and continue to do what they do, provide food, fiber, and fuel for the world. So our approach to this is going to remain consistent with that. And I appreciate the invite and being with you all today.
Okay. And with that, thank you, Eric. Thank you, Kristine. Thank you, Dustin. And I'm going to turn it back to Sherer to finish up the conversation that we've had today.
Great, thank you so much. I'm going to try to remember to share the RELAX with my family too. So thank you, Paul, and thanks to all of our speakers for the insightful discussion today. I'd also like to thank all of you in the audience for joining us and submitting your questions. We appreciate your engagement with us and would love to hear your feedback. So please take a moment to share your comments about today's session in the brief survey you will see at the conclusion of the forum. If you'd like to help us continue providing valuable programming such as today's forum, I'll quickly remind you about becoming a friend of Farm Foundation. Check the link provided in the chat to learn more. Each and every gift to Farm Foundation strengthens our ability to address rapidly evolving issues impacting agriculture, the food system, and rural communities. And we are so appreciative of your support. So just in conclusion, thanks once again for your participation today, and we look forward to seeing you at future events. Thanks.